Have you ever wondered what would actually happen if everyone woke up tomorrow and decided to pull all their money out of the bank? I mean, really thought about it? Because when most people imagine this scenario, they picture complete chaos. ATMs running dry, bank doors locked, the financial system collapsing overnight. But here's what nobody tells you. That nightmare scenario? It's not just possible. It's literally built into the system you trust with your money every single day. Here at Simple Money, we dig into the uncomfortable truths about how money actually works. And today, I'm going to reveal why your bank doesn't actually have your money, why that's completely legal, and what happens when too many people figure this out at the same time. So here's what's really happening every time you deposit money into your bank account. You think your money just sits there waiting for you, right? Like a safety deposit box with your name on it. You put in $1,000, the bank holds your $1,000. Simple. Except that's not what happens at all. The moment you deposit money, something fascinating occurs. Your bank takes about $90 of every $100 you give them and immediately loans it out to someone else. They keep maybe $10, sometimes less. Think about that for a second. Right now, while you're watching this, your bank has loaned out most of your money to complete strangers. People buying houses, starting businesses, funding their lives with your deposits. And this isn't some shady backdoor deal. This is called fractional reserve banking, and it's literally how the entire modern banking system works. Now, you might be thinking, wait, that sounds insane. How is that legal? Here's the thing. It works because of a simple assumption. The bank is betting that you and everyone else won't need your money at the exact same time. Most days, they're right. Some people withdraw cash, others deposit. It balances out. The bank keeps just enough money on hand to cover normal daily withdrawals, and everything flows smoothly. But what happens when that assumption breaks? Let me paint you a picture. Imagine you live in a small town with one main bank. Everything's fine until one Tuesday morning. A rumor starts spreading. Someone heard the bank might be in trouble. Maybe they made bad loans. Maybe they're running out of money. By lunch, a few worried people show up to withdraw their savings. Just to be safe, they tell themselves. Just until things settle down. But here's where it gets interesting. Other people see the line forming outside the bank. They don't know why people are withdrawing money. They just know something's happening, and suddenly they're worried too. By mid-afternoon, the line is around the block. Everyone wants their money. Right now. And this is where the system reveals its fragile foundation. Remember how the bank only keeps 10% of deposits on hand? Well, when everyone shows up demanding their money at once, the bank simply doesn't have it. It's not hidden somewhere. It's not invested in some vault. It's loaned out. Gone. This scenario has a name. It's called a bank run. And it's one of the most terrifying events in finance, not because it's rare, but because it's happened over and over throughout history. The Great Depression saw thousands of banks collapse this way. People lined up for days trying to withdraw savings that simply didn't exist anymore. Families lost everything because everyone realized the same truth at the same time. Now, let me tell you about the first trap that makes this system so dangerous. I call it the confidence game. Your bank's survival doesn't depend on how much money they actually have. It depends on whether you believe they have your money. The entire system runs on confidence, on trust, on everyone agreeing not to check if their money is really there. Think about how wild that is. The stability of your bank account depends on collective belief. It's almost like a magic trick. As long as nobody looks behind the curtain, the illusion holds perfectly. But the moment doubt creeps in, the moment people start questioning, the whole thing can unravel in hours. Here's why this matters for you. Every dollar in your account exists in two places simultaneously. It's yours, sitting in your account balance. But it's also loaned to someone buying a car across town. Both of you think you have that same dollar. Both of you are technically right, until you both try to use it at the same time. The psychology behind this is fascinating. Humans are wired to follow the crowd, especially during uncertainty. When we see other people panicking, our brains interpret that as a signal of real danger, even if we weren't worried before. Economists call this information cascading. You see your neighbor withdrawing money. You don't know why, but your brain thinks they must know something I don't. Better safe than sorry, and just like that, rational individuals create collective panic. Now, here's the second trap, the liquidity illusion. Most people think of their bank account as liquid money. Available instantly, accessible whenever you need it. And 99% of the time, that's true. But that liquidity is an illusion made possible by everyone not needing their money at once. Here's what actually happens behind the scenes. When the bank loans out your deposit, they're making a calculated bet. They loan it out long-term, maybe a 30-year mortgage, but they promise you can have it back immediately, anytime. This is called maturity transformation, and it's incredibly profitable for banks. They borrow short from you and lend long to others. The interest rate difference is how they make money, but it creates a fundamental mismatch. The bank owes you money on demand, but the money they loaned out won't come back for decades. Imagine if you ran your personal finances this way. You promise your landlord you can pay rent tomorrow, but you've actually loaned your rent money to a friend who won't pay you back for 30 years. That would be insane, right? Yet this is exactly how banking works, and it works fine until too many people want their money back at the same time. Let me give you a concrete example. In 2008, Washington Mutual was one of the largest banks in America. They had hundreds of billions in deposits. They seemed completely stable. Then, in just 10 days, customers withdrew $17 billion. $17 billion. The bank couldn't cover it. They collapsed. The biggest bank failure in American history. $17 billion sounds like a huge number. But remember, Washington Mutual had hundreds of billions in assets. The problem wasn't that they were broke. The problem was those assets were tied up in long-term loans, houses, mortgages, things that couldn't be converted to cash fast enough. They had the money. They just couldn't access it when everyone wanted it at once. Here's the cruel irony. The bank run itself caused the collapse. If people had stayed calm, Washington Mutual would have survived. Their loans were mostly fine, but the panic became a self-fulfilling prophecy. This brings us to the third trap, the domino effect. When one bank fails, it doesn't happen in isolation. Remember, banks loan money to each other constantly. They're all interconnected in this massive web of debt and credit. So when Washington Mutual collapsed, other banks that had loaned them money suddenly had problems too. And when those banks looked shaky, their customers started withdrawing money, which created more bank runs, which toppled more banks. Think about it like a game of Jenga. Each bank is a block supporting others. Pull out one block, and suddenly the whole tower becomes unstable. Pull out several blocks, and everything comes crashing down. During the Great Depression, this domino effect destroyed over 9,000 banks. 9,000. People who had their money in a perfectly healthy bank on Monday lost everything by Friday because a completely different bank failed 3 states away. The interconnection that makes the system efficient during good times becomes the mechanism of destruction during bad times. Here's what makes this even more terrifying. Banks don't just hold your deposits. They hold deposits from other banks, from businesses, from local governments, from pension funds. So when a bank fails, it's not just individual savings accounts that vanish. It's payroll for companies. It's operating funds for hospitals. It's pension payments for retirees. The ripple effects cascade through the entire economy in ways most people never imagine. Now, you might be wondering, if this system is so fragile, why hasn't everything collapsed already? This is where the fourth trap comes in, the government backstop. After the Great Depression, governments realized they had to prevent bank runs somehow. The solution was deposit insurance. In America, that's FDIC insurance. It guarantees your deposits up to $250,000 per account. The idea is simple. If you know your money is guaranteed by the government, you won't panic and withdraw it. The insurance prevents bank runs by removing the reason to run, and for the most part, it works. When you see FDIC insured on your bank, you sleep easier. You trust that even if your bank fails, you'll get your money back. But here's what nobody wants to admit. That insurance is itself built on an assumption. The FDIC insurance fund has about $120 billion in it. Sounds like a lot, right? Until you realize that American banks hold over $18 trillion in deposits. $18 trillion insured by $120 billion. That's less than 1% coverage. Now, the FDIC will tell you this is fine, because not all banks will fail at once. They can borrow from the government if needed, and historically, they're right. But think about what this really means. The insurance that prevents panic is itself dependent on not everyone needing it at once. We've created a safety net for a system built on collective faith. Using another system built on collective faith, It's insurance all the way down. Each layer depends on the layer below it not being tested too hard. Here's the fifth and final trap. The modern twist. Everything I've described so far happened in the past with physical bank branches and paper money. But today, everything's digital. And that changes the game in frightening ways. In the old days, a bank run took time. You had to physically go to the bank, wait in line, withdraw cash. It was slow. That slowness actually protected the system. But now, you can withdraw your entire life savings with a few taps on your phone at 2 in the morning. While sitting in your pajamas, if a rumor spreads on social media that a bank is in trouble, millions of people can attempt to withdraw billions of dollars in minutes. Not days, minutes. The system isn't built for that kind of speed. The safety mechanisms that worked when things moved slowly become useless when panic spreads at the speed of the internet. We saw a preview of this in 2023 with Silicon Valley Bank. News spread on Twitter that the bank might be in trouble. Within 48 hours, customers attempted to withdraw $42 billion. $42 billion in 2 days. The bank collapsed. Not because their investments were worthless, but because they couldn't convert those investments to cash fast enough to meet withdrawals happening at digital speed. So what actually happens if everyone tries to withdraw their money at once? Here's the uncomfortable truth. The government would step in before total collapse. They'd freeze withdrawals, declare bank holidays, basically force everyone to leave their money in the system whether they want to or not. This isn't theoretical. It's happened before. During the Great Depression, the government literally closed all banks for 4 days. If you needed money, too bad. The banks were closed by government order. More recently, during the financial crisis in Cyprus in 2013, the government froze bank accounts and actually confiscated a portion of deposits over 100,000 euros. Just took it. To save the banking system. When the system is truly threatened, your access to your own money becomes negotiable. The government will prioritize saving the system over your individual ability to withdraw cash. Let me tell you about Sarah. She's a marketing manager, makes decent money, keeps most of her savings in a high-yield savings account at an online bank. Sarah thinks of her savings as her safety net. She's got $30,000 sitting there, available whenever she needs it. It gives her peace of mind. But here's what Sarah doesn't realize. Her online bank doesn't have physical branches. If there's ever a run on that bank, she can't show up in person demanding cash. She's completely dependent on digital transfers working. And her $30,000? The bank has loaned out $27,000 of it. They're keeping $3,000 available to cover withdrawals. That works great until everyone wants their money at once. Sarah believes she has immediate access to $30,000. In reality, she has immediate access to her share of $3,000, assuming she gets to the bank before everyone else. Sarah's security is built on everyone else not testing the system at the same time she does. Now let me tell you about Marcus. He's a small business owner. Similar income to Sarah. But Marcus understands how fractional reserve banking works. Marcus keeps his emergency funds split across 3 different banks, not because he thinks banks will fail, but because he understands concentration risk. He also keeps some physical cash at home. Not a huge amount, maybe $2,000. Enough to cover a few weeks of expenses if ATMs stopped working or banks froze withdrawals. Most importantly, Marcus doesn't think of his bank balance as money he actually has. He thinks of it as money the bank owes him. That subtle mental shift changes everything. When news breaks about banking stress, Sarah panics and tries to withdraw everything immediately. She becomes part of the bank run. Her fear contributes to the very crisis she's trying to escape. Marcus stays calm. He knows his deposits are FDIC insured. He knows the government will intervene before total collapse. He's already diversified, so no single bank failure wipes him out. Sarah's money is technically safer because it's all in one FDIC-insured account, but her psychology makes her vulnerable. She'll panic, withdraw, potentially creating losses if she has to sell investments to get cash, or triggering problems at her bank. Marcus's setup might seem paranoid, but his psychology is protected. He can stay rational when others panic. Here's what most people don't realize about bank runs. They're not really about the money, they're about psychology. The actual financial system can handle stress. Banks can borrow from each other. The Federal Reserve can inject liquidity. The government can guarantee deposits. What the system can't handle is mass panic. When millions of people simultaneously lose confidence and demand immediate access to money that's been loaned out, the mechanics break down. It's not that the money doesn't exist. It exists. It's just not in the form or location that allows everyone to access it simultaneously. Think of it like a theater. The building is solid, the exits work perfectly. But if everyone tries to rush out at the exact same moment, people get trampled. Not because the building failed, because panic created a stampede. Bank runs are financial stampedes. The danger isn't the bank failing. The danger is everyone rushing to the exit at once. Here's the thing that keeps me up at night. Our entire modern economy is built on layers of trust and credit. Each layer assumes the layer below it is stable. But dig down far enough, and you realize it's all built on the assumption that not everyone will test the system at once. Your bank account isn't really your money sitting in a vault. It's a promise. A promise that's good as long as everyone believes in it. Your deposits are loaned out immediately. Those loans fund mortgages. Those mortgages are packaged into securities. Those securities are used as collateral for more loans. On and on. Each dollar creating multiple dollars of credit. It's incredibly efficient. It's how modern economies grow and thrive. But it's also incredibly fragile. The whole thing depends on confidence, on trust, on collective agreement not to all demand our money back at the same time. So what do you do with this information? First, understand that FDIC insurance is real and effective for normal bank failures. If your bank goes under, you'll get your money back. Eventually. Maybe not instantly, but you'll get it. Second, diversification isn't just for investments. Spreading your cash across multiple banks means no single failure wipes you out. It also means you're not dependent on one bank's systems working during a crisis. Third, keep some actual cash accessible. Not because banks will definitely fail, but because in any crisis, the first thing that happens is systems get overwhelmed. ATMs run out. Digital transfers get delayed. Cash in hand solves immediate problems while you wait for systems to stabilize. Fourth, understand that your psychology is the real risk. The people who get hurt worst in bank runs aren't those with the least money. They're those who panic first and make rash decisions. The system is fragile, yes, but it's also resilient. Governments will intervene. Central banks will provide liquidity. The FDIC will honor its insurance. Not instantly, not perfectly, but eventually. Your job isn't to beat everyone else to the exit. Your job is to be calm enough and prepared enough that you don't need to run. The fractional reserve system, the confidence game, the liquidity illusion, the domino effect, the government backstop. These aren't flaws in the system. They are the system. Understanding them doesn't mean you should panic. It means you should prepare, diversify, keep some cash, and most importantly, understand that your greatest vulnerability isn't the banking system failing. It's you panicking when everyone else panics. The people who survive financial crises aren't the ones who saw it coming and withdrew everything first. They're the ones who stayed calm while others panicked, who understood the system well enough to know when real danger existed and when fear was just creating more fear. So here's my question for you. Are you prepared not just financially, but psychologically for the next time the banking system gets tested? Because it will get tested again. That's not pessimism. That's history. Bank runs happen. Financial panics happen. The question isn't whether, it's when. And when that moment comes, your understanding of how the system actually works will matter more than how much money you have in it.